Alright, welcome everyone to my channel. So this is going to be the first video. It's going to be a quick summary on Pro Medicus, what they do, how they make their money and so forth, and the explanation on them. So to start with Pro Medicus, you might have guessed from the name, Medi. They're a medical company. They're worth $4.6 billion, so a massive amount, but they're expected to get high growth, largely because of their new deals and their constant expansion, which we'll get into later. So what do they do? They just deal with radiology. It's pretty simple, really. The business is actually quite simple and easy to understand. But it's actually priced at a really high multiple, so it's over 100 PE, which we'll get into later on why that is, and if they're worth looking into. But to start with, none of this is financial advice. It's not to be taken as financial advice, and please deal with this as your own peril, because I don't want to be liable for any gains or losses you make, and yeah, this is all up to you. Alright, so let's get into it. So who are PME? PME offer radiology software to hospitals, imaging centres, and healthcare groups around the world. They have 3 products: Visage 7, Visage IRS, and Visage Ease. Visage 7 is what they use in the US, so they've secured a bunch of US deals, which is the typical main thing that they use with radiology. And then you have Visage IRS, which simply just combines a bunch of features into one platform that healthcare centres, hospitals, medical centres can all use. And then you have Visage Ease, which is one of their new products they're launching. So in 2009, they bought out Visage Imaging, which has now become their main thing, and that's how they generate most of their revenue. So they rely heavily on securing deals with universities, medical centres, and hospitals, as you can imagine, to use their product and then go from there. So they all make their revenue depending on how much these centres use their product. So if their products use more revenue. If it's used less revenue. Pretty easy to understand. So over the past year, you'll see their growth in revenue is actually under 10%, same for profit, which they largely blame to COVID and due to the new deals expecting to start next year. But we'll get into the reasons why later and their charts, which basically explains that they've had over 100% growth in the past year, which is quite insane. As mentioned earlier, fastest growing large cap healthcare stock, and their competitive advantage is simply their technology. Their technology is ahead of any competitor by a mile. It's not even close. So key factors: 2 out of top 10 hospitals in the US have deals with Pro Medicus within the past 6 months. So we'll show those deals later, and they also have deals with the second biggest radiology providers in Australia and 2 major Germany deals. Now, Germany deals don't sound like a big deal, pun intended, but that's the main part of Europe, right? So that's their entrance into Europe, I should say. So if they can get German deals going, then they can hopefully expand and then so forth and so on. So they're still very new in the Europe market. They're starting to get a big chunk of the Australian market, and their main goal is to expand across the US as fast as possible. They also have new products. So One View is one of their new products that's coming out. But we'll talk about that later as well. So major risk, their competitive advantage. If a company manages to catch up and can offer their product for cheaper and it does similar to Pro Medicus, then they could have an issue. But the main benefit for PME is they compete on quality rather than price. So at the moment, because their quality is so far ahead of any other competitor, they can charge the price and charge it on a per use basis, which essentially just benefits them more than anyone else, and no one can compete with it, because even if they compete on price, the service they get is such lower that it's not even worth it for the medical centre or the hospital to transition over. So you also have expansion issues. So if the German deals have any major issues, then it could affect the rest of Europe, and then they might look at Pro Medicus as not worth the money or the transitioning cost, because you have to remember all these radiology centres are currently using some sort of product. So to transition over to Pro Medicus is going to cost a lot of money, and if they don't know if they're going to get a good return, then it might not be worth it. The other issue is decline in imaging rates. So as we'll get onto later, their deals are all based on paid per image. So if scans go down, PME's usage goes down, which means PME's revenue goes down, which means PME's profit goes down. So as you can see, it's a pretty big domino effect, and it's all pretty easily explained. But yeah, they justify their recent decline mainly due to COVID. So because of COVID, especially you'll see in their stock price after March, when the big crash was, it was at $20, and that was largely because of the uncertainty. So if people are going out less, people are obviously going to go to imaging centres less. People go get scans less, and then it means less revenue and so forth and so on. It also means less deals, so people are really worried about that. But now getting on to deals. PME signed a $40 million 7-year contract with Intermountain Healthcare. So that just simply covers Utah, Idaho, Nevada. And yeah, it's pretty straightforward. You can read it there if you want to. Be a transaction-based model, potential upside. If they use more than expected, win for PME. If they use less than expected, loss for PME. It's pretty simple with all their models, and it's a pretty simple business to understand. Next, PME signs $31 million 7-year contract with a major university health system in the US. So this includes several universities, and once again, there's also affiliates can sign up. And then if they do, more revenue for PME. If they don't, well, they still get the $31 million secured over 7 years. So win-win either way. The last deal they announced at the most recent is 18 million, 5 years with MedStar Health. So this just covers the DC region, and once again, transaction-based model, and it has the potential upside of more usage. Now we get on to financials, the fun part that everybody loves. All right. Revenue up less than 10%, gross profit up less than 10%, and same for unit profit after tax. Why is this? Because of COVID. So they've been securing all these big deals over the past year, but you need to remember it takes time to transition for these businesses to using Pro Medicus' software and getting it implemented. So Pro Medicus expect all this to happen over the next year and all this growth to happen over the next year. The problem here is you're paying for all this growth and there's a lot of downsides. So if none of this growth happens and for whatever reason imaging rates stay declining post-COVID, then you're going to have a big issue. The other issue you could have is if COVID resurges in the US, then that could be a big issue. Main benefit though, with the revenue being so low, is that it should be much higher next year, especially with the Europe deals coming through. So earnings per share. So if we take the half year 20 and we double it, so we'll say 25 cents for the year, you're putting them at a PE multiple of over 100, roughly 140, because the stock's at 40, so you times by 4, so we'll say 160, but yeah. However you want to look at it, around 120 to 160, depending on the share price. So that's quite a massive multiple for PE, but you have to remember their medical software, because they compete on quality, is actually not that bad in terms of profit. As you can see, it's above 30, just under 30%, sorry. So it's quite a good profit margin. So now cash to debt. Cash, 51 million cash, 0 debt, and operating cash flow, 17 million in cash flow. So this is essentially just free cash. So the way you should look at this is it's in terms of how profitable the business is, and then how much money they're generating that they can use elsewhere. So 17 million operating cash flow essentially means they have 17 million to spend in other areas. So they can spend that in growing new products, they can spend it expanding current products, or they can spend that on marketing and getting new deals. So now we'll look at the chart and where to from here. So the chart for PME. So the chart, as I said, started at 20, but once again, a bit biased because it's just after the March crash where they crashed down from about 30. So if you look at the chart, this is all just going to be basic technical analysis. So if you're into that, hopefully this helps you a bit. But yeah, so the chart goes up to $30 and bounces back down around the June-July period. Once again, technical analysis, you'd expect it to hit $30 resistance level and bounce back down over their new deals. Then price more or less stagnates. They hit new deals, and then the price once again floats around $30. Manages to crash past the $30 mark, and since then, as you can see, it's just a steady upflow all the way to $45. Along the way, they had some issues. So you'll notice a green spike around January. That was when they announced the deals with the universities in America. And then you'll notice the sudden fall off when the results came in. This was largely because people were expecting so much growth at results. People were playing it for earnings. Everyone was buying into PME just for the earnings, and then as you can see, the massive volume. Everyone just sold out when earnings came out and caused a domino effect. Earnings were not bad. Earnings were quite good for PME. People just had insane expectations, and it since then found $45 to be the resistance level and $40 to be the support level. So it's trading within quite a narrow range of only around 10%. So where it'll crash to from here, nobody knows. If it crashes below 40, it could get potentially back down to 35, and then you'd expect it to bounce. If it goes above 45, then it could get as high as 50. If it hits 50, then I expect it to find more resistance because it's a nice round number and people like to sell at round numbers. Afterpay is a perfect example of that. When it hit $100 for the first time, it sank back down, and now we know the story. They flew all the way up to 150 and they sank back down below that. So yeah, I don't think there's much room to go here for the stock from a technical analysis perspective. But once again, that's up to you for to analyze and discuss all in one take. All right, but yeah, thank you for listening, guys. Hopefully this helped you understand PME a bit more, and yeah, have a good night.